Hey, what's up, guys? Welcome back to IronHawk Research. We are an organization that's passionate about spreading financial literacy to help people to build a better financial future. So, today we're going to talk about beta. Beta is a very, very important concept in portfolio management. If you want to learn how to invest, you have to understand beta. Beta is a measurement of systematic risk of a security, a stock, or portfolio compared to the market as a whole. If a stock has a beta higher than 1, then the stock is said to be more volatile than its benchmark. For example, the S&P 500. So how do you calculate beta? So beta is equal to the covariance between the stock's return and the market return over the variance of the market return. You can use this formula to calculate beta, or you can also use the CAPM model, CAPM, Capital Asset Pricing Model. To use CAPM to calculate beta, you are required to perform regression analysis. We're going to talk about that in another video. So today we only focus on using this formula to calculate beta. Let's use Excel to demonstrate the process. Okay, so in this sheet we have the daily price data for SPY, which represents the movement of the S&P 500, and also the price data for Apple stock. So in order to calculate covariance, we need to first of all calculate the return data for the S&P 500 and the Apple stock. So the return for SPY and the return for Apple are calculated as follows. For the SPY, we have B3 divided by B2 minus 1. And for Apple, we have C3 divided by C2 and minus 1. And these are the daily return data for SPY and the Apple stock. Let's drag them down. So now we have the daily return data for these two stocks. Now let's go ahead and calculate the covariance between these two stocks. So to calculate covariance, we can use an built-in formula in Excel, which is equal sign cov. You can see covariance.p and covariance.s both works. .p means for the population and .s means for the sample. So for here, we're going to pick .p, and then you have array 1, which is, according to formula, the return data for the equity, which is Apple, right? And for array 2, we have the return data for the market, which is the SPY, the S&P 500, and close bracket. Now you see the covariance. Next, we need to calculate the variance for the market, which is the SPY. We can also use a built-in formula for variance, which is equal sign bar .p, or you can use .s, doesn't matter. And then the variance of the return data of the market, which is here, right? Close bracket. So now we have the covariance and the variance. So the last thing we need to do is divide covariance by the variance to get the beta for the Apple stock. So beta is equal to covariance divided by variance. Now you get the beta for Apple stock. So apparently, the beta for Apple is 1.25. Remember, we're using 1 year of data here, right? So this beta only represents for the past year. If you want to calculate 3 years of 3-year beta or 5-year beta, you can definitely use different data sets, but you will get a different result. And remember, the beta represents how volatile the stock compared to its benchmark. So Apple is more volatile than the S&P 500 for the past year because the beta is greater than 1. How do you actually apply this to real life investing? So for example, if you feel the market is a bit risky or you want to reduce your exposure to the market, you need to overweight on stocks with lower beta or adjust the beta of your entire portfolio to be below 1. If you feel the market is going to be great, you want to take more risk, you want to buy stocks with a higher beta or adjust the overall beta of your portfolio to be greater than 1. Alright, that's beta. Hopefully you guys enjoyed the video. Please let us know what you want to learn next in the comment section down below. Thank you very much for watching, and I'll see you next time.